With Chapter 2, we begin to learn how to manage our money. The beginning of each chapter lists our learning objectives for the chapter. Identify the main components of wise money management, create a personal balance sheet and cash flow statement, develop and implement a personal budget, and connect your money management activities with savings for personal financial goals. A basic definition. Money management is founded on your day-to-day financial activities. Much like many diets direct you to keep track of everything you eat, to get a feel for where your money goes, do the same for every dollar you spend. Track it for a week or even a month, and you'll have a clear picture of exactly what you're spending money on and where you may want to change. There's a worksheet for this and several apps to help you track your spending as well. 3 main activities. Step 1. Maintaining an organized file for your financial records is important. You definitely need them to file your taxes each year. Further, you need to keep records of financial transactions and your budget. This slide lists not only what should be included in your personal financial files, but also the whys of having an organized system of filing and storage, and they're really just common sense. Handling daily business activities, like bill paying, planning and measuring financial progress, completing required tax reports, making investment decisions, determining what to do with available resources. Not all records need to be kept in hard copy paper form, nor do all need to be kept in your home. Items that you refer to frequently need to be readily available, such as tax records, your employment contract, credit reports, and investment records. For many items, off-site storage, such as the safe deposit box, is a good option. Barring that, a fireproof safe in your home would be an alternative. Most of us keep a lot of our financial records in digital form, now either on a home computer or stored in the cloud. Note these items may be kept in a home file on a home computer or online. Items you refer to frequently. Remember, they need to be readily available. This is Exhibit 2.1 for examples of each category. The question comes up frequently, how long to keep things? This slide lays that out clearly. Birth certificates, marriage license, Social Security info, you keep them forever. Property and investment records, as long as you own them. Tax returns and supporting info, 3 years for sure. 6 is better. I'd keep it a little longer. This graphic from the text just recaps what we just discussed on the previous slide. Most of us keep a lot of our financial records in digital form now. So what should you consider keeping on your personal computer? Current and past budgets. This is where you keep track of your progress. If you bank online, as many do today, a full summary is available online. Just for security, you should download a summary periodically, and definitely at the end of the year, if for no other reason than for tax purposes. If you use tax prep software, which I highly recommend, and we'll discuss in Chapter 3, then your tax return will be on your computer. Definitely back this up to offline media. If you have an investment account, your account summary is also probably available online as well. Treat it like your bank data. Finally, digital versions of your personal finance documents, will, estate plans, etc., they should be on your own computer. While easy, this raises several security issues. Back up your files regularly on external media. Use security software to protect your system from hacking. Use very secure passwords for all the critical sites. If your files are stored in the cloud, download and store copies offline periodically just for added security. We focused on what to keep. What about what to toss? Sales receipts for non-tax deductible items and expired warranties can be thrown away as long as they do not contain any credit card information. Any document which has any personal information on it should be shredded. And periodically empty the recycle bin on your computer so any data deleted is not available to hackers. 4 very good reasons to create and update your personal financial statements. It shows where you are right now versus your goals, measures your progress toward those goals, tracks any activities, provides information needed to file your taxes each year. One of the 2 most important personal financial statements is your personal balance sheet. If you've had accounting, this is going to be very familiar to you. For a company, this is called a balance sheet. For individuals, it can be referred to as a net worth statement. Basically, you recap the value of all items you own, all amounts owed, and the difference is your net worth. This is very similar to the information a bank will require prior to granting a loan, such as a mortgage. So let's create a personal balance sheet. Step 1. List items you own in order of liquidity, as in a traditional balance sheet, but the categories are a bit different for an individual. Liquidity refers to how quickly an item can be converted to cash without a significant loss in value. Liquid assets include cash, checking and savings account balances, money market values, and the cash value of any life insurance. Real estate is clearly a long-term asset, and for most, its value will be offset by a corresponding liability in the form of a mortgage. Personal possessions include your car, stereo equipment, furniture, jewelry. Investment assets include retirement accounts, mutual funds, any investment account values. The sum of these is total assets. Step 2, liabilities look much more like their corporate versions, current and long-term. Current liabilities are those that will be paid off within 1 year, medical bills, credit card balances. Long-term liabilities would include your home mortgage, auto and student loans. The sum of these, total liabilities. Step 3, total assets minus total liabilities equals your net worth. This is Exhibit 2.2 in your text. If creating a balance sheet is new to you, you need to review this exhibit. Pay careful attention to where items are placed under each category. There are problems in Connect which require you to take a list of values and place them correctly in a balance sheet. And as I've already mentioned, your personal balance sheet is the one document designed to track your progress toward your financial goals. Our overall goal is to increase our net worth. Net worth is not a measure of available cash. It measures how much you'd have left if you sold all your assets and paid all your liabilities. Looking at the example on the slide. Assets, $193,000. Liabilities, $88,000. Net worth, $193 minus $88, $105,000. Insolvency is defined as having liabilities that far exceed your assets, resulting in an inability to pay debt when due. Obviously, we want to avoid this condition, and monitoring your personal balance sheet is critical. Now that you have a better picture of how net worth is measured, it should be fairly obvious how to increase it. Increase your savings. That'll increase your liquid assets. Reduce spending. Decreases your current liabilities. Increase the value of your investments. Reduce the amounts owed. Like its corporate counterpart, a personal balance sheet is a snapshot in time, as of June 30th, 2022. The other important personal financial statement is the cash flow statement, or personal income and expenditure statement. This is a bit different from the standard corporate statement of cash flows, but the objective is the same. Where did money come from and where did it go? Cash flow statement generally reflects a period of time, a month for example. An individual's inflows typically include net pay from employment, net of taxes and any other deductions, interest income earned on investments, proceeds from the sale of an asset. Outflows include two types of expenses, fixed and variable. Fixed expenses may include those which do not change month to month. Variable are those which, as the name implies, they vary, and we'll look at these more closely. Step 1. Record income from all sources. Take-home pay, commissions, self-employment, interest, dividends, gifts, grants, whatever. The bottom line, if you get money from any source, record it. Step 2. Fixed and variable expenses. Fixed expenses may include rent or a mortgage payment, a loan payment, cable internet, insurance, life and home. Variable expenses, food at home, food away from home, clothing, your telephone bill, electricity, personal care, medical, recreation. This is important since fixed expenses are exactly that. They're fixed. They must be paid each month. If cuts need to be made, they need to be made from the variable expense list. Step 3, determine your net cash flow. Surplus or deficit. This is Exhibit 2.3 from your text. It's a hypothetical cash flow statement for 1 month. Step 1, income. Step 2, cash outflows, fixed and then variable. Step 3, net cash flow and the allocation of surplus. The difference between income and cash outflows will hopefully be a surplus. If it's a deficit, then adjustments in variable expenses need to be made, and quickly. Assuming a surplus of funds, a decision needs to be made concerning their allocation. In this case, the surplus was allocated between emergency savings, savings for specific goals, and long-term savings. Once you create a cash flow statement for yourself and see what's coming in and where it's going, it's time to consider a budget to help you live within your income, spend wisely, reach your financial goals, save for emergencies. It's a spending plan. This is Exhibit 2.4. It offers some typical financial goals for 3 life situations. Single person, short term, finish college and pay off a car. Intermediate, vacation in Europe, pay off your student loans, go to graduate school. Long term, vacation home, retirement. Also, married couple and parent with no children. Note that providing for retirement is a long-term goal in all 3 situations. Without children, goals can include vacations and new cars. With children, insurance and savings for college seems to take precedence. This slide recaps the steps in order for developing a budget. The first step is obviously decide on exactly what your financial goals are. Short term, pay off all your credit cards. Medium term, pay off your student loan or save for a house. Long term, save for your children's education or for your retirement. Remember the SMART approach to goal setting. Once you have a clear idea of what you want your money to do, you can start working toward those goals. If you work at a regular job, one paycheck, then estimating your income for a month may not be too hard. If, on the other hand, you freelance or have various sources of income, this may be a difficult step. Note that budgeting for emergencies and savings is high on the list. Pay yourself first. Fixed expenses come next as they have to be paid. Budget variable expenses and then record actual amounts each month to detect patterns for review and revision. Once you've done this for a month or so, you'll have a clear picture of where you may need to make adjustments. Budgeting is a circular process. Review, revise as needed, go back to step 1. Remember, a successful budget must be well planned and planned by all involved. It's got to be realistic, based on the realities of your income and expenses. It's got to be flexible. You have to prepare for emergencies, new tires, a new water heater, clearly communicated. If this is a family budget, then everyone has to buy into it and agree to follow it. Budgets can take many forms, depending on the complexity and your personal needs. A mental budget may just be fine if the dollars are limited. Physical budget using envelopes or folders may seem old-fashioned, but it can work. Written budget could be on notebook paper or accounting paper. Remember those green sheets? Today, there are many software programs specifically designed for budgeting, or you could just design your own using Excel. Whatever method you feel is appropriate for you and your family, the key is to get started and stick with it. Sample worksheets are available at the end of the chapter and are posted as Excel worksheets in Blackboard. This is Exhibit 2.5. It's a sample monthly budget for a family. Notice the steps followed that we outlined. Step 1, they clearly stated their goals. Step 2, estimate their projected income. Step 3, budget for emergency funds and savings. Step 4, budget fixed expenses. Step 5, budget estimated variable expenses. Step 6, record actual expenses and variance to budget. Step 7, evaluate whether revisions are needed based on the surplus or deficit. This is Exhibit 2.6, and it gives some average budget allocations for 6 different family life situations. Student, working single, no dependents, couple with children under 18, single parent with young children, parents with children over 18 in college, couple over 55 with no dependent children. Comparing your own expenses to these can give you an idea if you're spending too much in one category and what you should be allocating to different categories. Note that housing and food are large percentages for every category, with transportation a close second. A SWOT analysis may be a familiar term to those who've had principles of marketing. SWOT, strengths, weaknesses, opportunities, threats. Companies use this type of analysis to focus on where they are, where they want to be, and what stands in the way. You can employ the same methodology to your financial planning. This sample SWOT analysis will show you how it's done and how to do one for yourself. Figure out what your financial strengths are. No debt, flexible job skills, and your weaknesses. High credit card debt, car needs repair. Opportunities, there's apps to monitor finances, part-time work, and threats, inflation, uncertain job situation. We've covered the 3 basic financial planning documents you need to begin to manage your money and work toward achieving your financial goals. Your balance sheet tells you where you are financially at any one time. Your cash flow statement helps you track income versus expenses. Your budget details your plan and allows you to track variances to plan. The overall goal is to use your cash flow statement and budget to improve your balance sheet, increase your net worth. So what'll change your net worth? Now that you've seen what a personal balance sheet looks like, it should be obvious. If your outflows exceed your inflows, you spend more than you make, then you'll have to draw on savings or up your credit card debt, either of which will decrease your net worth. If your inflows exceed your outflows, then you have money to save, invest, or pay off debts. That'll increase your net worth. The savings part is very important. As noted, everyone's financial plan should include saving for retirement, and it's never too early to start, and no amount is too small to start. Remember the power of compounding. There are several ways to set up an automated savings plan that removes the temptation to spend the money. Writing a check to yourself every month is one method, but far better would be automatic transfers to a savings account or automatic deductions from your paycheck if your employer has a credit union. Dumping pocket coins into a piggy bank will add up, as will small savings on an ongoing basis, such as bringing your lunch instead of eating out, bringing your own coffee and skipping Starbucks. Whatever method you choose, make it a regular habit. Exhibit 2.7 in your text shows the results of 3 savings plans at 3 different rates of interest. Admittedly, today, investing at 7, 8, or 12% would be amazing since rates are closer to 1%, but it does illustrate the principle involved. Plan 1 is a simple lump sum of $6,000 invested at 7%. After 10 years, the amount has almost doubled to $11,802. Plan 2, saving for retirement, deposits $2,000 each year at 8%. After 10 years, the plan yields $28,974. Plan 3, saving for a home, deposits $200 every 3 months at 12%. In 10 years, this results in $15,080. In all cases, the power of compounding drives the growth. This actually completes Chapter 2. We'll summarize our learning goals for this chapter. Learning Goal 1, identify the main components of wise money management. Learning Objective 2 was the critical one, creating your personal balance sheet and cash flow statement. This is one of the most important steps in beginning to gain control over your personal finances. With any project, you have to know where you are now, balance sheet and cash flow statement, versus where you want to go and how you're going to get there, budget. We've covered the budgeting process as 7 steps, beginning with setting specific financial goals and ending comparing your budgeted value versus actual ones to detect areas that need revision. For example, if you always seem to overspend on clothing and entertainment, then you need to decide which one you're cut back on. Keep a clear eye on fixed expenses, as those are non-negotiable. You have to pay your rent or mortgage, light, gas, and water, and loan payments before anything else. The final step is connect your financial activities with savings towards your goals. Here's where using the time value of money methodologies can help you see how much you need to save invest every month or year to achieve your goals. This ends Chapter 2.